What everyone believes about the housing crisis is wrong, and the real story is way more disturbing than rising interest rates or lazy millennials. Imagine waking up in 2012 to find Wall Street buying your neighbor's foreclosed home, then the house across the street, then entire blocks disappearing into corporate portfolios before families could even bid. Even the economists who study housing couldn't fully explain what was happening at the scale it was occurring. Let me show you what was actually happening behind the scenes. While everyone focused on recovery from the 2008 crash, private equity giants were engineering the largest transfer of residential property in American history. Blackstone founded Invitation Homes in 2012 and spent $10 billion acquiring nearly 50,000 foreclosed single-family homes at rock-bottom prices. They weren't buying homes to flip them, they were converting the entire asset class from ownership to permanent rentals. It's like if someone bought every bicycle in your city and told you that from now on you can only rent them, never own one again. The official story blames housing shortages and zoning laws. That explanation is convenient for investors. It's also misleading because the real trigger was regulatory complexity and pandemic policies that crushed small landlords while private equity firms swooped in with billions in cash, no inspection contingencies, and the ability to close in days. And then someone made it exponentially worse. By 2015, institutional investors had doubled their market share from 8% to 14% of home purchases, and they never retreated. Within a decade, corporations came to own 1 out of every 11 residential properties across 500 U.S. counties, with some markets hitting 20% corporate ownership. In Atlanta, private equity now controls over 30% of single-family rentals, disproportionately targeting Black neighborhoods. By early 2025, investors accounted for 27% of all home purchases nationwide and 44% of home flips in certain markets. First-time homebuyers found themselves outbid by all-cash corporate offers on starter homes under $300,000. The American dream became a bidding war families couldn't win. This is when the system turned algorithmic. Companies like RealPage developed pricing software that allowed corporate landlords to share confidential rental data and coordinate rent increases without ever meeting in a room. For years, this digital collusion operated in plain sight, and the decision to automate greed transformed scattered rent hikes into synchronized price surges across entire metro areas. But here's what still affects you today. This transformation is why rent has skyrocketed 31.4% since 2019, while wages increased only 23%, forcing families to earn nearly $80,000 annually just to avoid being rent-burdened. The policies created then, tax incentives for opportunity zones, eviction moratoriums that favored large operators, and regulatory burdens that crushed mom-and-pop landlords, built structural advantages for corporate giants that persist today. The 6 largest corporate landlords raked in $300 million in additional profits in just 1 quarter of 2024, primarily from rent hikes. And the people who caused it, like Blackstone, earned $2.3 billion in profit from their housing venture before taking Invitation Homes public, while displaced families saw their home ownership dreams vanish. Financial crises aren't accidents, they're patterns, and we keep pretending each one is unique when they all follow the same script. A market crashes, Wall Street buys assets at the bottom, regulatory capture ensures they keep their advantages, and ordinary people pay higher prices forever. The 2008 housing crisis didn't end, it just changed who collects the rent. Drop a comment on which economic disaster I should explain next: the student loan trap, medical debt, the gig economy scam, and subscribe because I'm breaking these down every week, exposing how the system really works when nobody's looking.